I'm presenting today joint work with Jim Alm of Tulane University, and since we've now gotten very insightful talks on the, I would rather say, practical experience, I think our paper here fits in nicely and contributes to that discussion, in that our work here aimed to provide a better understanding of the effects of audits on post-audit tax compliance. So what we've been interested in was to better understand to what extent differences in the effectiveness of audits to detect non-compliance affect subsequent reporting compliance. And the literature typically when discussing the effects of audits on taxpayers, and we've talked a lot about already to what extent the COVID pandemic has impacted revenue agencies' capacity to conduct audits, but more generally, the literature on the effects of tax audits distinguishes between direct effects and indirect effects. Now, the direct effects of tax audits obviously refer to the revenue that is collected in direct response to the audit outcomes. So whenever non-compliant taxpayers are detected, ideally the tax administration will be able to bring in some money from those audits. However, in addition to these direct effects, audits do also have indirect effects on taxpayers. And on the one hand, they influence compliance in the aggregate. So an increase in the probability of agencies to conduct audits typically translates into an increase in overall compliance levels. But there's a second indirect effect of tax audits, and this is what I'll be talking about today, which is the effect of tax audits on audited taxpayers. This is typically referred to as the specific deterrent effects of audits. And as most of you know very well, I assume there is very much evidence which suggests that enforcement, that audits are an important cornerstone in promoting compliance. And there's a rich body of evidence suggesting that more audits lead to more tax compliance. However, it is typically assumed in almost all work on the effect of audits that audits detect all cheating that is present. Whereas in reality, this is obviously not necessarily the case, and there might, on the other hand, also be cases where audits detect more non-compliance than is actually present. But in this talk here, I'll be focusing on the case where audits detect less cheating than present. And this is what we refer to here as audit effectiveness. So the capacity of a tax audit to actually detect cheating when it is present. There's a variety of other behavioral issues that are not really well understood at this point. For instance, to what extent audits have differential effects on different types of taxpayers as distinguished by their prior reporting behavior. I'm going to touch on this a little bit, but I'll more focus on the effects of variation in audit effectiveness on post-audit tax compliance. Now, you might be wondering why there's a lab experiment on this agenda here today, which many practitioners are maybe rightfully so somewhat skeptical of. But I'll be trying to convince you that this approach is very well suited to broaden our understanding and to look into this issue, because it's very difficult to investigate this particular aspect of the enforcement process, the effectiveness, the capacity of audits to actually detect cheating outside the lab. And I'm going to go into some more detail on this a little later. But what do we know from the existing literature on the effects of audits on subsequent compliance? So the specific deterrent effect of audits. Somewhat surprisingly, there's a large behavioral, mostly experimental literature, which relatively consistently finds that audits actually reduce subsequent tax compliance. So in many of those studies, taxpayers who experienced an audit become actually less compliant in the subsequent period. And this term has been coined as the bomb crater effect, and I think has been introduced quite widely in the literature. However, I acknowledge there's, of course, some skepticism towards this general tendency. And of course, it would be very bad finding for practitioners when the aggregate response to audits would be negative. And fortunately, findings using field data provide a different perspective on this. So there's an emerging body of evidence suggesting that the revenue effects of tax audits are positive. And these studies typically investigate the effect of random tax audits. And there's now evidence from countries such as the UK, the US, but also Denmark. And most of these studies, or typically on average, these studies find that audits do increase subsequent compliance. However, there's also evidence from field data which suggests that there are differential responses to tax audits. So these studies, for instance, one by Norman Gamble and Maria Rado, looking at administrative data from the UK, find that whether or not audits increase subsequent compliance depends on whether or not the audit finds the taxpayer to be compliant or non-compliant. So in their study, they found that taxpayers who were audited and found to be compliant decreased their subsequent compliance, whereas they found the anticipated effect among non-compliant taxpayers. So taxpayers who were audited and found to unreport their income, those taxpayers become more compliant in subsequent years. Similarly, in some of our own work using data from US self-employed taxpayers, we also found that the aggregate effect of tax audits on risk-based tax audits is positive. However, that there's still a differential response, and allow me to take a minute to walk you through our results here. So we investigated to what extent audits of self-employed US taxpayers increase or decrease their subsequent reporting compliance. And we distinguished between different taxpayers as evaluated by the IRS. So on the one hand, we had those who received a positive assessment, taxpayers who were audited and found to be owing tax. And on the other hand, we looked at taxpayers who were audited and found to not owe any tax. So those taxpayers did not receive an additional assessment. And we found, as you can see, I think quite nicely here, a very strong differential response conditional on whether or not the audit found you to be a non-compliant or to be a complier. While in the right-hand panel here, we see that audited taxpayers, the red line, increased their post-audit compliance by roughly 60% in the years after the audit, compared to a matched control group of unaudited taxpayers, the blue line here. We see the opposite response among taxpayers who were audited and not found to be owing any tax. So pre-audit, those taxpayers who would then eventually be audited report a little more income than their unaudited counterparts. However, post-audit, the picture reverts, and those individuals who have been audited actually report less income than their unaudited counterparts. So this again indicates that audits seem to have the potential to induce differential behavioral responses. And it's not really clear at this point what actually drives these responses. So they've been documented in the literature, but we do not know that much about what actually contributes to such differential responses. And the literature here gives us some guidance towards understanding what might be going on here. In the traditional standard econ perspective, audits only have an effect on subsequent reporting behavior in terms of changing subsequent reporting behavior when they provide the taxpayer with new information. So when a taxpayer is audited and he or she learns that the tax administration is better or worse at doing their jobs in terms of detecting more or less cheating than anticipated, then the taxpayer will use this information in his future reporting decisions and accordingly increase or decrease his reporting compliance. So in a world where all information is publicly available and where the audit does not provide the taxpayer with any new information, audits should not really induce any change in subsequent reporting compliance. However, there's also much evidence emerging from the behavioral literature, which suggests that compliance decisions are not necessarily in line with these standard theoretical predictions. So I referred to the bomb crater effect already as an example of an apparent systematic misperception of the risk of a future audit after experiencing an audit. But there's also other work suggesting that taxpayers might use heuristics to estimate the risk of a future audit. Early by around Feinstein, the term of loss repair was introduced here, which suggests that audited taxpayers might want to make up for losses that they have incurred as a result of a past audit, and as a consequence, fine more aggressively. That means file less honestly in subsequent years. And there's also some work on the fact, and we talked about trust and the interaction between tax administrations and taxpayers already, touching upon this dynamic. And this literature suggests that audits might have the potential to crowd out compliance among mostly honest individuals who comply because they, for instance, believe it's their civic duty to pay their fair share. And then once they're selected for an audit, they might perceive this audit as a signal of distrust, which in turn might reduce their commitment and their willingness to comply in the future. So there's some conflicting explanations for what we found here. And in the study I'm going to talk about right now, we try to shed some light on the relevance of those different explanations in explaining the behavior responses to audits. Now, to repeat, we were mostly interested in figuring out to what extent variation in audit effectiveness, or the share of non-compliance that an audit detects, impacts on subsequent compliance. So can a lack of audit effectiveness explain why some taxpayers report less in the reporting periods that succeed their audits? Do audits have differential effects on different types of taxpayers as distinguished by their prior reporting levels? So does it make a difference whether we audit someone who has a history of filing honestly or dishonestly? And again, we use a lab experiment to investigate these issues because it's extremely difficult, and I think Christoph will talk more about the difficulties in assessing the effect of audits outside the lab. And it's particularly difficult to get a good estimate of how effective an audit was, because I think by its very definition, each audit that the tax agency conducts only results in some estimate of the tax burden of that audit to taxpayers, but it's very hard to find out to what extent this assessment is actually correct or not. And so within this controlled world that we're looking at here, we have full transparency about all these factors. We can introduce variation not only in the probability of audits, but we can also introduce variation in the effectiveness of audits to detect non-compliance, and we can also observe true compliance levels, which allows us to identify very neatly to what extent these factors affect post-audit tax compliance. I'm not going to go too much into detail on the technical background here, but we ran a relatively large-scale lab experiment with over 300 individuals that allowed us to observe over 9,000 compliance decisions. And as I just mentioned, we introduced variation in the probability of audits. So we endowed participants in the experiment with income, and we told them, you have to declare this income. You can declare as much as you want, but you face a risk of being selected for an audit. And in case you're audited and found to be cheating, then you'll have to pay a fine. And we also told them that those audits that they were randomly selected for might differ in their effectiveness. So in some instances, an audit would result in detection of the entire undeclared amount, but in other instances, the audit would only detect some fraction of the non-compliance that the taxpayer might have exhibited. And all these factors were fully transparent. So there was full transparency, no insecurity whatsoever. And I think this will be important later in interpreting our results, because obviously in reality, things are far less clear-cut. So let's look into our results a little bit. On average, we find a bimodal compliance distribution, and this is very typical for this type of research. So a substantial share of participants do not report any income in any of the reporting decisions, and a substantial share of reporting decisions are fully compliant. So I think this is fairly typical for this type of research. But what's also fairly typical is that we find a gender gap in terms of compliance, where male participants, so the darker bars here, are substantially more non-compliant. So they evade substantially more than female participants. Again, we looked at the general deterrent effect of audits, so to what extent increasing the risk of audits affects compliance levels in the aggregate. And then we also looked at how audits affect the post-audit compliance of audited individuals. And this graph here shows to what extent an increase in the risk of detection translates into higher compliance levels. And it's to establish and to demonstrate that overall reporting behavior was very, very rational in terms of very strongly aligned with the incentive structure that participants faced. So when the risk for detection was relatively low, of course, even still much higher than in reality, but when there was an 18% risk, for instance, for being audited and found to be cheating found to be detected, then individuals only reported less than 50% of their income, whereas at the other end of the spectrum, when the risk of detection was very high, with almost 50% on average, participants reported close to 80%. So this is to demonstrate overall that reporting behavior in the aggregate was very rational and very strongly responsive to changes in the underlying enforcement parameters. However, when looking at the effect of experiencing an audit on subsequent compliance, where again, from a standard perspective, we shouldn't expect to find any behavioral response because all information was publicly available, and being selected for an audit is just a case of losing the lottery, so to say, and this should not have any impact on whether or not you become more or less compliant in the future. We still found that audit effectiveness matters. So what we show here is the difference in compliance between different indicator variables. So overall, whether you've been audited or not in the last round doesn't really have an effect in the aggregate on compliance levels. However, as you can see here, as the audit effectiveness increases, so as the share of non-compliance that is actually detected in an audit increases, so does reporting compliance in the subsequent compliance decision. And we looked at this from different perspectives. The paper obviously is much more technical and much more complex than this year. So we used simple interaction effects, but we also ran a diff and diff on this, fairly untypical for a lab experiment. But however we look at this, we also always find similar comparable results. So overall, in the aggregate, we do not find a strong effect of audits on subsequent reporting compliance. What you can see here is the change in the reporting compliance between the round that is unaudited, that is audited, and the subsequent round for taxpayers who actually do experience an audit and taxpayers who do not experience an audit. And here are different levels of audit effectiveness, and we see again a similar trend. The only instance where the audited taxpayer reports more relative to the taxpayer who's not been audited is the case where the audit actually detected all non-compliance. So to put some numbers on this, we estimate, depending on the methodology, that an effective audit that detects all non-compliance increases compliance between 3 and 5 percentage points. And we estimate, even though we do not reflect this in our experimental setup here, that an audit which does not detect any non-compliance, so a fully ineffective audit, so to say, diminishes post-audit tax compliance by, again, 3 to 5%. And these findings are statistically significant and robust to a whole battery of robustness checks. We also looked at whether or not experiencing audit repeatedly diminishes this divide in the behavioral response to effective and ineffective audits, and we found no evidence for this. So here you can see the change, whether or not compliance goes up after an audit or goes down. For effective audits, the blue dots here that detected all non-compliance, or ineffective audits that did not, and we see, I think, fairly consistent patterns here, that whenever the audit detected all cheating, compliance goes up, and when the audit did not detect all cheating, compliance tends to go down. We also looked at differential responses of relatively compliant versus relatively non-compliant taxpayers. I'm not going to present this here in more detail, but we found that the aggregate response here is mostly driven by relatively compliant taxpayers. Maybe somewhat astonishingly, we can talk about this a little bit later, maybe in the discussion, but we found that those individuals who never declare any income, for instance, that do not respond to any change in the incentive structure, they also do not respond to experiencing an audit. Whereas those who were more responsive to changes in the tax system parameters, those individuals showed the strongest response to experiencing an audit, and they also showed the strongest response to experiencing audits with different levels of audit effectiveness. So to wrap up here, what do we find? We find that increasing the risk of detection has a very strong effect on compliance. However, we also find that experiencing an audit can have differential effects on compliance. And we find that an audit that does not detect any cheating reduces post-audit compliance between 3 and 5 percentage points, whereas an audit that detects all non-compliance that has been present increases subsequent compliance by 3 to 5 percentage points. This effect does not diminish in audit frequency. And we also, I briefly touched upon this before, also do not find any evidence for crowding out effects. But I want to reiterate here that while these behavioral responses might appear to be slow, they might appear to be small, they are statistically significant at all conventional levels, but we also believe that they're lower bound estimates because there was so much transparency and so much certainty in our experimental design, and we really would not have expected to observe any differential response to these different types of audits. So my last slide here, a few seconds left. What I think can we learn from this? I think tax agencies in principle should aim to publicize any increase in their capacity to conduct audits. They should probably not publicize any decrease in their capacity to conduct audits, but they should make publish whenever audits become more likely for taxpayers. And Christos, I think, will talk more about the effectiveness of different types of audits, but this also seems to be an important issue, and this also touches upon the last presentation. I think increasingly relying on audits that are conducted by correspondence or maybe even online might be less well suited to deter future non-compliance of audited taxpayers. And the third point I would like to make here is that our results suggest that the lenient interpretation of tax laws in audits or bargaining processes or bribery, or however you want to call this, is likely to reduce post-audit tax compliance. So those audits that are conducted by tax agencies should be as thorough and as detailed as possible. And I'm going to leave it at this, and I'm looking forward to taking your questions. Thank you.
Thank you, Matthias. Superbly kind of interesting presentation. And the effectiveness of auditing is fairly unexplored, although well understood amongst operational people in tax administrations. I mean, but certainly in terms of research, I mean, it has been fairly unexplored. Now we have a discussion now, Miguel Fonseca, who's based here at TARC. Can I remind you, if you have any questions, please use the Q&A box to post them. Thank you. Miguel, over to you.
Yep. Thanks very much. I hope you can see my slides.
Yes.
Yep. Sorry, my computer is a little bit slow.
Okay. So hopefully you can see my slides. So first of all, really interesting paper. It was really interesting to read it. A really great example of how to use lab experiments to tackle a really relevant issue in tax administration. As a minor caveat, and I added this at the very last second while I was listening to your talk, not all lab data actually shows evidence of the bomb crater effect. A paper by Chu and co-authors in 2016 compares undergraduate students with people who are taxpayers, either self-employed or not, shows that the bomb crater effect seems to be an artifact of maybe undergraduate students. But anyway, I think this is a great paper. I think I'll reiterate the point that you've made. I think tax evasion is only imperfectly observable after an audit happens. And of course, audits might not be completely effective. So lab data is actually, I would pitch to the audience, as a really useful complement to working with compliance data sets from tax authorities. I'll add that lab behavior can actually be a very good proxy of real compliance behavior. A really recent paper in Management Science shows that people who cheat in the lab are actually more likely to engage in fraud in the field. So they use fraud in public transportation because it's something that they could actually measure. But this is actually the beginning of a series of papers that are currently under reviewed that are trying to link like behavior in the lab with behavior in the field. And I would encourage people in the audience to reach out and engage with behavioral economics, which nowadays can really be incorporated in surveys. You can incorporate it in your own survey work whenever you work with taxpayers. In terms of the results, I thought that the result that compliance post-audit really depends on audit effectiveness was really interesting. I was very surprised by what I'm going to call a non-linearity, especially with low effectiveness and medium effectiveness. I know you didn't have time. I had the advantage of reading the paper. The fact that these behaviors, or at least what you'd expect to see, seems to be driven by the top 50% of taxpayers, the more compliant side of the distribution, is really interesting. I wonder, from purely out of interest, what is the reason for that? Are these people different in any way that you measured? Because their compliance behavior is a function of who they are, right? So is it that they're more risk averse? Are there personality traits or occupational experience differences that might mean that they're more compliant and therefore more reactive to policy interventions? So I think that's really an interesting question that you may want to dig a little bit deeper. Another question that I had was that, and of course you didn't have time to explain this, but in your experiment, you varied the audit rate and the effectiveness rate across, I believe, 20 odd decisions. So varying to what extent you might have had low probability being audited, but being highly effective, to a case where they would be both low. What's interesting is that even though you showed these treatments, as it were, it's almost like each decision is a separate treatment, was random. There might be a history effect in the sense that you might have people who did your experiment that experienced very low effectiveness in the beginning of their trial, and then moved to decisions that had very high effectiveness, and vice versa. Probably not all of them, but a substantial proportion of them would have had that experience. And that resembles a lot a policy change. It's almost like you have a sudden regime change. Maybe the tax authority has more resources, or maybe there was a budgetary cut that removed effectiveness. It would be really interesting to see whether or not you have these effects going on, because it sort of, again, approximates a really interesting policy question around regime changes. The other thing that I wanted to say, and I think you alluded to this when mentioning as a segue to Christos's presentation, was the idea that in reality, audit rates and audit effectiveness are unknown to taxpayers. And I think a really interesting question here is, in that event, what is my prior belief about that audit rate and that audit effectiveness? And does that mean that the deterrent effect is greater or large, or greater or smaller, depending on what I believe the tax authority is? And also, as I learn, right? So if I don't know and I'm surprised, does that mean that I'm going to react differently than if I was very pessimistic and I'm pleasantly surprised? So I think that's a completely different experiment, but it would be a really interesting question for future. So again, really interesting paper. Pleasure to read it. I think that's my 5 minutes. So thank you.
Thank you, Miguel. Thank you for a very interesting discussion. Matthias, would you like to respond to Miguel's comments within a minute or so?
Yes, I would like to thank Christos. Thanks, Miguel. Fantastic comments. Too bad we can't grab a coffee right now and chat about this later. So very quickly, let me just touch on 2 points. And I think everything you mentioned is perfectly well taken and very helpful. So I agree it would be very interesting to explore more what drives these differential responses of relatively compliant and relatively non-compliant taxpayers. We've thought about a lot, but we hadn't thought of this, and no one ever discussing this ever has. So this is really appreciated, and I'll try to link this to our survey data, which we have, and to get a better understanding of what's going on there. And I also like this idea very much of looking into the history. I think if I had to start from scratch again, I would design the experiment a little bit differently. There was a lot of noise, a lot of changes going on, and in the follow-up studies, we'll be less rigorous in having all these different levels of all the factors involved. So what we're doing, for instance, in the follow-up study, and this much I can say, is we would like to track more consistently with Matt Raven, who's here, I think, with us as well, to track more consistently how this updating of priors actually works. So whether there's a mismatch between the objective probability of an audit and how likely people perceive the audit actually to be, and to what extent this is affected by the audit experience. And I think this potentially also might be a nice contribution to that literature as well. So yeah, much appreciated. Thank you very much. Great comments.